Hey everyone, investing in startups can be an exciting opportunity, offering the potential for high returns, but it's not without its risks. If you're considering backing an early-stage company, it's crucial to know what to look for. In today's video, we'll cover 15 key things to consider before investing in a startup. From evaluating the team to understanding financial risks, we've got you covered. Let's dive in. This is Wealthlocity. Here you create, protect, and grow your wealth. Fast. First and foremost, it's important to acknowledge the high level of risk that comes with startup investing. Around 90% of startups fail, and when you invest, there's a good chance that you might not see a return, or even lose all your investment. By understanding the inherent risks, you can set realistic expectations. Startup investing is not for the faint-hearted, and it's best to approach it with the mindset that this is capital you can afford to lose. Diversification is key. Don't put all your money into a single startup. Invest in multiple startups to spread the risk. A startup's success often hinges on the quality of its founding team. Do they have the experience, skills, and passion necessary to execute their vision? Look for teams with complementary skills. One founder might handle the technical side, while another focuses on business development and operations. A great idea can fail without the right people behind it. Founders who have experience in the industry, a deep understanding of the problem they're solving, and a track record of success in previous ventures are more likely to overcome the inevitable challenges startups face. If you believe in the team, it's a good sign for the investment. Make sure you fully understand the startup's product or service. What problem does it solve? Is it addressing a pain point that customers are willing to pay for? Also, evaluate how the product is differentiated from existing solutions on the market. Investing in something you don't fully understand is risky. A strong product or service solves a real problem and offers a clear value proposition to its users. If you can see the product's potential to disrupt the market or fill a gap, it's a good indicator of future success. Market demand is critical for a startup's success. Even the best product will struggle without a large enough market. Ask yourself, is there a growing demand for this product? How big is the target market? And are there enough potential customers to scale? A startup operating in a growing market with rising demand is more likely to scale and succeed. Conversely, a product with limited demand in a niche or shrinking market may struggle to gain traction. Understanding the size and potential growth of the market helps you assess the startup's scalability. The business model is the core of how the startup plans to make money. Does the startup have a clear path to revenue? Is the model scalable? Are there multiple revenue streams, or is the company reliant on just one? A sustainable and scalable business model is essential for long-term success. Look for models that can adapt and grow as the company expands. If the business model is reliant on heavy upfront investments with no clear path to profitability, it might be too risky. What makes this startup stand out from its competitors? Does it have a unique technology, an innovative approach, or a strong brand that gives it a competitive edge? Startups that differentiate themselves are more likely to gain market share. A strong competitive advantage can be a moat that protects the startup from being overtaken by competitors. This could come in the form of proprietary technology, intellectual property, or even a first-mover advantage in a new market. The more difficult it is for competitors to replicate the product or service, the more secure your investment. Traction is a clear indicator of a startup's momentum. This could include things like user growth, revenue generation, customer testimonials, or partnerships. Traction shows that the product has market fit and that customers are engaging with it. Startups with early traction demonstrate that they're on the right path. Traction can validate the business idea and reduce some of the risk associated with the investment. Without traction, the startup may still be in the conceptual phase, which increases uncertainty. Financials are a window into the startup's current health and future potential. Look at the startup's burn rate, how fast they're spending money, revenue, and cash flow. Do they have enough cash to get through the next 12 to 18 months? Startups with high burn rates and low revenue may struggle to survive without additional funding. It's important to invest in startups with sound financial planning and a runway that allows them to hit key milestones. If the startup is constantly chasing more funding just to stay afloat, it may not be a stable investment. How will you eventually get a return on your investment? Most startups aim for an exit through an acquisition or an IPO, an initial public offering. Check whether the startup has a clear exit strategy and if there's a realistic path to achieving it. Your return on investment depends on a successful exit. Without a clear exit strategy, it's hard to know when or how you'll see your money back. Look for startups that have a clear plan for growing value and achieving an exit, whether it's through a sale, merger, or going public. Consider valuation. Valuation is a critical factor when investing in startups. How much is the startup asking for, and is the valuation justified? Startups with inflated valuations may struggle to raise future rounds of funding, or you may not see a significant return on your investment if they don't live up to expectations. Investing in a startup at an inflated valuation can reduce your upside potential. A fair valuation means you're getting a reasonable share of the company for your investment, and it increases your chances of seeing a good return if the startup grows as planned. Know your investment horizon. Startup investments are typically long-term. You might not see a return on your investment for 5, 7, or even 10 years. Be prepared for a long wait and make sure you won't need access to this capital in the short term. Startup investments are illiquid, meaning you can't easily sell your shares until there's an exit. If you need liquidity sooner, this might not be the right investment for you. Understanding your own financial situation and investment timeline will help you make the right decision. Look at the cap table. The cap table, or capitalization table, outlines the ownership stakes in the startup, showing how much equity is held by founders, employees, and investors. Reviewing the cap table helps you understand how much ownership dilution could occur in future funding rounds. If too much equity has already been given away, or if future funding rounds will result in significant dilution, your shares may become less valuable over time. A clean cap table with fair founder and investor ownership is a good sign that the company is well structured for future growth and investment. Consider the legal structure and intellectual property. Check the legal structure of the startup and ensure that they have intellectual property protections in place. Startups with strong IP, such as patents or trademarks, are better positioned to protect their innovations from competitors. Without a strong legal foundation, startups are vulnerable to lawsuits or IP theft. Investing in a startup that has properly filed patents or owns critical technology gives you confidence that the company can defend its market position and maintain its competitive edge. Chapter 14. Know the industry and trends. Take a look at the industry the startup is operating in. Is the industry growing or is it shrinking? Are there any trends or disruptions on the horizon that could affect the startup's chances of success? Investing in a startup in a declining industry increases your risk, as the company may struggle to grow. Conversely, startups that are riding industry trends or entering growing markets are more likely to succeed. Understanding the industry and its future direction helps you gauge the startup's potential for growth. Trust your gut. Finally, trust your instincts. Startup investing is as much an art as it is a science. If something feels off, whether it's the team, the business model, or the industry, don't ignore those signals. Startup investing often involves many unknowns, and your intuition can be a powerful tool. If after doing your due diligence you feel confident in the startup, then go for it. However, if something doesn't sit right with you, it's okay to walk away. It's better to miss an opportunity than to invest in something you're unsure about. So, there you have it. 15 essential things to consider before investing in a startup. Investing in startups can be a rewarding way to grow your wealth, but it's crucial to go in with your eyes open and understand the risks. If you found this video helpful, don't forget to hit that like button and subscribe for more investing tips. Thanks for watching, and I'll see you in the next video with more money in your pocket.